Welcome to the Three Corners Capital third quarter investment webinar. I'm Steve Fortin, and along with my partner Chris Flores, we're very pleased to host Andrew Choi with Parnassus Investments today. This conversation is being recorded on Friday, June 27th, just a few days before July and the beginning of the third quarter. And because most of the country and here in Cincinnati, we've already entered the 90-degree temperatures and high humidity. And with all the hot news out there economically and politically, many investors are just trying to stay cool. So we've titled today's webinar, Cool Investing in the Dog Days of Summer. And fortunately, we have a cool and very calm professional portfolio manager to help us beat the heat this summer. Before I introduce Andrew, just a few words about our work for clients. And, we research and we utilize a lot of research and investment strategies from a wide range of viewpoints and industry players. Parnassus is one of the leading firms we rely on in that endeavor. And so we greatly appreciate their partnership and willingness to share insights with our clients and friends. We also appreciate the investment approach of Parnassus, which is highly selective and focused on high quality companies that are both likely to thrive in a healthy economy and be resilient in a downturn. So with that said, pleased to introduce Andrew Choi. He is the lead portfolio manager of the Parnassus Growth Equity strategy and one of the managers of the Parnassus Core Equity strategy. He joined the firm as a senior analyst in 2018. Prior to joining Parnassus, he worked at Deloitte Consulting as a business analyst. He received his bachelor's degree in chemistry from Princeton and his MBA from Harvard Business School. So thank you once again, Andrew. Great to have you here. And let's get off to our first question, which is regarding the economy. Since our last webinar, we've had mixed signals on the U.S. economy. While job growth has slowed, the labor market still remains, relatively healthy overall. Inflation data for May showed, smaller than expected increase, suggesting that rising tariffs haven't yet significantly impacted prices. However, consumer confidence is shaky and uncertain. Economic growth has been muted, and forecasts are for perhaps a slowdown coming in the second half of the year. The uncertainties of tariffs and trade policy, tax policy, deregulation and regulation, the wars in Ukraine and the Middle East, all of this can increase hesitancy and caution on the part of consumers and businesses. So I know that you and Parnassus are primarily bottom-up stock pickers, but how has this economic backdrop and this policy uncertainty impacted your decision-making in recent months?
Yeah, thanks, Steve. Thanks for having me, and a great question to kind of kick off. And just starting up front, to reiterate, everything we do is through the lens of stock picking. So we manage a concentrated 40 stock, primarily U.S. large cap focus portfolio, a focus on quality with deep sustainability integration and low turnover. We try to buy high quality businesses at attractive valuations, and that's not always possible unless there's some sort of investor debate or something going on in the broader macro or something specific with the company. So we're always leaning into areas where there's investor debate. And you mentioned so that's the context in which we look at the world, right? So we're at the end of the day, we're looking for 40 stocks that we think will outperform the S&P 500, the broader market, and we navigate the world through that lens. And you mentioned mixed signals, and I'd say it feels like we've had mixed signals for the past 5 years on the economy. I think if you go back to 2020, you go back to the recession concerns at the end of 2022, it feels like more of the same, and it almost feels like the pace of mixed signals is actually accelerating, and we've certainly seen that since the administration change at the end of last year. And this is all to say that I think our core decision-making process, it hasn't changed whatsoever. In fact, we describe ourselves out externally as stock pickers, but internally we talk about being decision makers and really focusing on high quality decisions. And when you have a scenario where, especially this year, there's been almost daily or weekly changes in policy, rhetoric or stances or developments, geopolitical conflict, mixed signals on the economy, right? It feels like we've been talking about muted growth or moderating wage growth and lackluster employment data for years effectively, right? So, I think, or the soft landing debate, right? That's sort of re-emerging as well. And at the end of the day, we look at, the core fundamentals of the economy coupled with expectations for the businesses in the market, coupled with, the expectations for the businesses that we own, and where do we see attractive risk reward. And I think, it's important context to set that at the end of last year, when we had the administration change, there was kind of a euphoria around an expectation for pro-growth, pro-business, deregulation. You saw kind of a rally in the financial sector. You saw the healthcare sector sell off based on some policy expectations. And I think as we entered this year, you had sort of a whiplash moment where a lot of what was talked about from the administration was very anti-growth, very isolationism, right? And that kind of explains the Q1 sell-off that we saw from February down to the trough in April. I mean, it's hard to fathom that the market was down close to 15% not just a few months ago, right? And I think now we're on track to finish up double digits for the year. And I think that's really just a reflection of the fact that the market was pricing in the tail risk, right, of moving and decoupling from the broader global economy, right, and pricing in the ramifications of what that would be. And I think tariffs plus isolationism and undoing some sort of decades of efficiency gains would clearly be a painful process. And I think until the market was able to see that the policy had some bounds, right, some checks on it, right, and I think you started to see that with the rhetoric shifting based on moves in long-term rates, right, based on what they were willing to give. And I think it's now consensus that where we're going to land with tariffs and what trade deals are announced, or it's clearly not the goal. Doesn't seem to be a complete decoupling from some of our larger trading partners, nor are we seemingly doing things that we're willing to give up sort of our reserve currency status. So you put that all together, and then you overlay that with a durable, increasingly strong kind of AI secular investment tailwind. And that explains sort of the return to animal spirits that we saw in Q2 with like a pretty strong rebound, right? So that's our like high level interpretation on what's been going on in terms of our decision making process, right? We are, we stay close to all of our sectors. I think in Q1 there were opportunities where correlations in certain sectors went to one. We upgraded the quality of some of the stocks that we own. We bought sort of like premier leaders that used to be trading at like a pretty stark premium to the rest of their peers. But I think once that spread starts to narrow, you can kind of get interesting opportunities to upgrade parts of your portfolio. So our turnover is actually tracking in line to below average entering this year, and I think part of that was we were already moderately defensively positioned. I think some of the euphoria we felt like in Q4 was a bit unfounded last year. I think we didn't expect the extent of the sell-off in Q1, but I think we were fortunate to be relatively defensively positioned. And then after this rally, it's understandable that we kind of overshoot on both sides, right? So for us, it's important to not get caught up in making decisions, right, based on sort of short-term things that can change, right? So we're trying to ground ourselves on what will the world look like in 18 months, what companies are positioned to benefit from, secular tailwinds, where like the range of outcomes are skewed favorably. So in general, that core decision-making process still remains the same. It gets tested a lot more when you have this kind of mixed signal news flow.
Right, for sure. So that's a good lead into my second question, which is around the valuations for U.S. stocks. Overall, they've been on the high side, especially when looking at the S&P 500, on a market cap weighted basis. They corrected a good amount in April, as you mentioned, but they bounced back, really quickly. And it's also the case that, profit margins for a lot of these companies are near, all-time highs as well. So how is your team thinking about current valuations?
Yeah, I mean, certainly when the market was at, now we're approaching 22 times forward, right? Despite earnings expectations being cut a little bit, just given some of the, kind of the blip that we had in Q1 and Q2, or Q1 going into Q2. But when you step back, right, like and this is like a well studied and documented phenomenon, right? Like the comparison of the market multiple relative to historical periods, right, has to take into account the differences in business quality that makes up the index, right? So you've got effectively more than a third of the index now, right? If you're talking about the S&P 500, in pretty dominant kind of monopolistic, super high ROIC, high growth, durably wide moat businesses that sort of deserve to have a premium. But when you look at those businesses, it doesn't actually, and that explains why like the market overall might deserve a higher multiple than in the past, right? Like more growth, more dominant, higher ROIC, more free cash flow generation. Sort of like all of these giant conglomerates that are operating in winner take most markets, which probably definitely didn't exist 15 years ago, didn't exist to the extent that it does now 10 years ago. And so the historical, the market should trade at blank multiple comparisons are we don't find that argument to be as compelling because you kind of have to look bottoms up and look at the actual makeup of the market. And then when you actually look at the makeup of the market, you can just start with there are certain areas where I think the multiple that's being put on some GDP growth industrials or industrial cyclicals, like we could have a pretty healthy debate that like should that really should those sectors be valued in the way that they should be. But if you look at like kind of the high profile tech stocks or the mega cap tech stocks, outside of Tesla, which we don't own, and kind of operates in a different, valuation framework, these dominant AI beneficiaries like Amazon, Microsoft, Alphabet, Nvidia, they're not actually trading in a range that we think are, a super high cause for concern, right? So these are businesses that will grow earnings in the mid to high teens in some cases for at least 3 to 5 years, right? In most base cases, and they're trading at, in Alphabet's case, 18 to 19 times earnings. In Amazon and Microsoft's case, call it 33 times earnings, or the low 30s in terms of an earnings multiple. And I think those are, in terms of risk reward, some of the more attractive places to be in the market. So clearly, there is some level of animal spirits, broadly speaking. It's certainly not bubble territory by any means. Are we starting to edge a little pricey, even in like the names that I just mentioned, like a Microsoft, for example? Yes, but it's within the range where I think you could still justify a pretty acceptable return owning a stock like that here. So if you think about that, a third of the index, right, growing earnings at a high teens rate durably, and then what multiple does that trade at in 3 to 5 years? The risk reward skew still feels relatively attractive. I think there's certain areas outside of that might be more challenged from a stock return perspective. But yeah, I mean, that's like the broad comment on the market, but we're definitely seeing, animal spirits back into the market, right? Like I think once the market has digested the fact that, we're not going down a path of anti-growth isolationism, that, the geopolitical conflicts and flare-ups, seemingly have stabilized or are not escalating or accelerating into a worse, kind of expanding conflict. Couple that with just the biggest sort of technology infrastructure build out that we've ever seen, period, and definitely like rivaling the telecom build out, the fiber telecom build out, with way more imagination kind of allowed, right, to speculate on like the return that you can see on some of this investment. Clearly that's explaining a lot of the return to a risk on market, which we're definitely in now.
Yeah. So you mentioned artificial intelligence, and that's been such the buzz and a lot of hype, but there's a lot of optimism around that. Tremendous potential, huge investments in semiconductors, infrastructure, et cetera. But there's also real risks and concerns for society and the labor market and so forth. Could you share a little bit more about your thoughts around pros and cons and how your portfolios are positioned for the growth of AI?
Yeah, I mean, let me start with how we're positioned, and then sort of and then work my way back up to the big picture of how we think about this, and maybe share a little bit about our process and maybe what makes us different. But I think it's pretty well known that you can kind of bucket the AI exposure into sort of the obvious beneficiaries that are the enablers. So talk about the picks and shovels semiconductor companies. We clearly own NVIDIA, Broadcom. We've recently purchased AMD, right? These are companies that are selling the chips that are enabling a lot of the AI, foundational technologies. We have large positions in Amazon, Microsoft, and Alphabet. These are sort of the data center operators, right? So again, these are sort of the enablers of the AI economy, right? They're building giant data centers, building, actually putting the chips into racks, plugging them in, and then building sort of the middle layer of software that enables all of the other stuff to happen, right? And I think those are the areas where we continue to maintain a net overweight stance, right? Like I think regardless of how the economy shakes out, how agentic AI takes off, what applications win or lose, these companies will be net beneficiaries, right? So that's like the anchor positioning to our AI exposure. And then where we end up taking some risk is, it's clearly debated what types of software companies are AI winners and losers, right? So there's very healthy debate around whether companies like Salesforce, Workday, right, will continue to persist in the way that they look like today in the future. And it's debated whether they can monetize a lot of the AI products that they're currently trying to develop and sell. So we have quite a bit of software exposure from horizontal software like that, ServiceNow, Workday, Salesforce. We own some vertical software in Synopsys, which is like a design software company. We own software that serves small, medium businesses into it. So there's and we also own obviously Microsoft and a bit of Oracle, right? So that they are, I think of those more as like infrastructure providers, but big software businesses. And I think that is sort of the more controversial area, but an area that we think will benefit and is well positioned over the next couple of years to participate in the AI economy. And the simple framework we use is if you own a sticky workflow and you have proprietary data for a lot of large enterprises, it's actually your game to lose, right, in order to deliver AI solutions. And granted, there's a range of outcomes on all of these things, but the idea that if you have a system of record, a privileged position to have like the database and the data and information that is really valuable to train certain models or to execute or automate certain workflows with AI, you're actually pretty well positioned relative to like a startup or a different company. So we have some overweight exposure there, and then we start to look through the rest of our portfolio, and we always ask, right, like, is this company going to be on the right side of history or not, right? Like, if we enter a world in which there's robots doing everything, right? You have robots walking down the street, and physical labor, to the extent that it's a low skill labor or a highly manual or dangerous task, and it starts to get roboticized or automated, right? We kind of think about these scenarios and ask ourselves, like, does the business that we own today, what will it look like in that 5-10 year period? Mm-hmm. So we kind of use that framework to say, like, is there existential or terminal value risk here? Are there opportunities for this business to adopt certain technologies? So businesses that have a lot of on the flip side, if you have a lot of tasks or jobs today that are very labor intensive and costly, that can be automated, right? And you have something that's really sticky or a business model that allows you to sort of retain the value that you're providing to your customers, and you don't have to pass through all the cost savings. Those are great opportunities to kind of own AI adopters that will create a lot of value. So, starting from the enablers all the way down to the application providers, then to the adopters, that's kind of the framework that we use relative to AI. And you alluded to this, which is like the kind of the dislocation in the labor market, or some of the issues that might arise from and sort of like ethical questions that come up, right, when it comes to labor versus capital, when it comes to like AI algorithms, right? We've been fortunate to kind of be working in the sustainability space for quite some time, where we have a dedicated team that literally thinks on a longer term time period, right, and asks like, okay, with the advent of some of these technologies, where do we see some of the issues emerging that the average spreadsheet analyst might not think about, right? So if you're doing earnings for the next 3 years in Microsoft, you might not be thinking about some of the government intervention or labor issues or dislocation issues or frictions that might emerge in certain areas when it comes to like automation or labor replacement. So that's definitely an area we spend a lot of time on. But in general, right, like, and it's going to differ by different markets. But it's the classic analogy is the invention of the spreadsheet, right? Like I think when the spreadsheet first came out, there was a lot of concern about like accounting jobs and jobs that did math, right? And I think like clearly there's more accountants now, there's more people who are doing math and delivering services. That's definitely going to be a part of it, right? Like the market is pretty good at adapting labor to the highest value tasks at any given time. And there'll be a ton of new jobs, right, being created. And I think it'll also enable a lot of folks to create more value in the economy, right, with the help of AI and agents. And I think, that's obviously the optimistic kind of hope from this all. But, we like to balance the view with that too. So.
Yeah, no, that's great. Yeah, I was thinking about spreadsheets the other day, talking to somebody, and I'm old enough to remember when I encountered my first spreadsheet opportunity. I don't know if you were born yet, Andrew, but
Yeah. It's and it really is one of those things where it is a new disruptive tool, and the only analogy that I've experienced is like going from the flip phone to the smartphone, right? And that felt very organic and not maybe more organic than going to like an AI chatbot that's like all knowing and omnipotent, right? But I mean, I know like at Parnassus, we're already like basically fully AI enabled, right? Like all of our decision making and research process is completely integrated to some sort of AI tool. And what you're able to do and how efficiently you're able to do it, that definitely changes. But the core job of making high quality decisions, that still remains on the table.
Right. All right, great stuff. Well, I see that we are about out of time. So thank you very much, Andrew. This has been fantastic. We really appreciate you being here and sharing your knowledge and insights today. Thank you to all of our clients and guests for watching today. If anybody has any questions or would like to discuss how this impacts your planning, your portfolio, please feel free to reach out anytime. And so thanks again, everybody. Stay cool out there and have a great day.
Thank you.
Thank you.